Looking to invest $10,000, wondering which ETF, VGT or SCHD is better for you? One focuses on technology, while the other focuses on dividend-paying companies. Today I'll show you which one is a better option. In this video, I'll show you and John what sets VGT and SCHD apart, from their money-making methods to their risk levels. We'll compare them side by side to help you determine which one aligns better with your investment goals. I'll show you a long-term projection with a $10,000 one-time investment in each. And the difference is significant. One has the potential to exceed a $2 million portfolio value, while the other can generate over $25,000 in annual dividends. In the end, I'll show you how you can achieve similar returns with monthly contributions of less than $150. The first question is, why consider an ETF and not stocks? ETFs, or exchange-traded funds, are investment funds that are traded on stock exchanges similar to stocks. They hold a collection of assets like stocks, bonds, or commodities and aim to track the performance of a specific index, such as the S&P 500. ETFs offer diversification, meaning you can invest in many different companies or assets at once. So if you're looking for a safer investment that lets you own a bunch of different stocks or securities all at once, ETFs could be for you. They're usually cheaper than the funds you'd get from a hedge fund or a mutual fund, and they're also more tax-friendly. Plus, you can use them to quickly spread out your investments across various industries, countries, or types of assets, like bonds or commodities. This is a great way to diversify your portfolio easily. Even though ETFs come with a small yearly fee known as the expense ratio, it's often very low. If you don't have the time or desire to pick and manage all these investments yourself, ETFs can be a huge time saver. Okay, first things first, let's set the stage for our two funds. VGT and SCHD are both popular choices among investors, each with a unique focus and investment strategy. VGT is a well-known fund that started in 2004. It tracks the MSCI U.S. Investable Market Information Technology 2550 Index, which includes many of the biggest names in the tech industry. The ETF has around $74 billion in assets under management, making it a heavyweight in the technology sector. This ETF is all about growth, investing in companies like Apple, Microsoft, and NVIDIA. These companies are known for their innovation and potential for rapid growth, but they also come with higher volatility. On the other hand, SCHD began in 2011 and focuses on the Dow Jones U.S. Dividend 100 Index. This fund targets companies that not only pay dividends, but also have a strong history of growing those dividends. SCHD has about $56 billion in assets under management. This ETF is designed to provide a steady income stream and stability, which can be appealing during market downturns. There are some key differences to note when investing in these two ETFs. First, VGT has a higher expense ratio compared to SCHD. VGT's expense ratio is 0.1%, which is more expensive than SCHD's 0.06%. While both are relatively low cost, SCHD is cheaper to hold. Understanding these differences is crucial when choosing between VGT and SCHD. Both have their strengths, but the best choice depends on your investment goals, whether you seek growth with VGT or income stability with SCHD. Next is diversification, which brings us to our next chapter: holdings on the two ETFs. Let's take a look at the main companies each of these popular ETFs invest in. When we compare them, we can learn some interesting things, and let's simplify it. Starting with VGT. This ETF is heavily concentrated in the technology sector. In fact, it's 99.25% made up of tech stocks, focusing on leading companies like Microsoft, Apple, NVIDIA, and Broadcom. Not only that, it has a portfolio of 316 stocks, all of which are from the tech sector. This concentration allows VGT to capitalize on the rapid growth and innovation within the tech industry, though it also subjects the fund to higher volatility and sector-specific risks. On the other hand, SCHD has a completely different approach. It emphasizes high dividend-paying stocks across various sectors, promoting stability and income generation. Its top holdings include Texas Instruments, Amgen, PepsiCo, and Lockheed Martin. This diversification across healthcare, consumer staples, and telecommunications sectors ensures a steady dividend yield and lower volatility compared to the tech-heavy VGT, making SCHD an attractive option for conservative investors seeking reliable income streams. Overall, the differences in holdings and their weights can lead to significant variations in performance between the two ETFs over time. In the end, I'll show you how this different approach can end up being a difference of a 5-fold return. After that, I'll show you how to reach a portfolio valuation of over $2 million or a portfolio that pays over $25,000 in annual dividends with a less than $150 per month investment. Back to our topic. Based on the stock from the portfolio, the question is, what's better for you? To answer this, you need to know the strategies these two ETFs use to generate returns for their investors. So from our previous discussion, if you compare concentration versus diversification, VGT's strategy is to capitalize on the rapid growth potential of technology companies. However, this focus on tech also introduces higher volatility and sector-specific risks, meaning the fund can experience significant swings based on the performance of the technology sector. In contrast, SCHD takes a more conservative approach by targeting high dividend-paying stocks across various sectors. These companies have a strong history of not only paying dividends but also growing them. Its strategy aims to provide a stable and reliable income stream through dividends, making it a good fit for income-focused investors. The fund's diversification across multiple sectors helps to mitigate risk and reduce volatility, offering a more stable investment compared to the tech-heavy VGT. What this means for you is that if you're excited by technology and don't mind a bit of risk when interest rates go up, VGT could be your pick. But if you're looking for something a bit steadier and want to get paid in dividends, SCHD, with its focus on the broad market, might be more up your alley. But that's not all. You also have to take into account how good or bad each ETF's historical performance is. When we invest, we're all looking for good returns without too many ups and downs. So let's simplify this. When we compare VGT and SCHD's performance over different periods, we get a clearer picture of their returns and potential for growth. Let's start with the year-to-date return. VGT has shown a year-to-date return of about 10.03%, while SCHD's return sits at around 5.19%. This shows that tech stocks, which VGT focuses on, have done well this year. Looking back over the past year, VGT has returned about 35.09%, thanks to the strong growth in tech stocks. On the other hand, SCHD, which focuses on stocks that pay dividends, has had a return of around 14.12%. It's not bad, but not as high as VGT, which, as we've established, is more tech-focused. For the long term, SCHD has done quite well, with a 10-year average return of about 113.83%, but VGT has done even better, with a 10-year average return of around 488.19%. Overall, VGT has had higher returns across all time frames, mainly because of the rapid growth of technology stocks. Now, in the end, I'll show you whether this growth alone is enough to make it a better investment than SCHD. And I'll also show you how and which ETF will help you reach $2 million with only a $150 per month investment contribution. Now, if you're wondering where I get all this data from, let me tell you about our channel's official partner, Seeking Alpha. It's been my go-to tool for winning in investments. It's easy, it's simple, and I love how I can access under-the-radar investing ideas, earnings call transcripts, and breaking news. Plus, the exclusive data-based stock rankings have been a game changer. Stocks rated strong buy and their alpha picks have actually beaten the S&P 500 by over 80%. So definitely check them out in the description, as they've promised to give a 20% discount on premium membership with a 7-day free trial and a 10% discount on alpha picks to members of our community who join using the link from the video description. back to our topic. We've seen that VGT has performed significantly better than SCHD when it comes to stock price, but there's more to a fund than just how much the share price has grown. Let's dive deeper and compare them on a few other things that matter to investors. For starters, which we just saw from the graphs, SCHD has an average share price appreciation of 7.9%. Next, we consider the current dividend yield, which for SCHD stands at 3.34%. Lastly, we look at dividend growth, which for this ETF stands around 10.87%. The same figure for VGT looks something like this. Average share price appreciation of 19.27%, current dividend yield of 0.68%, and average dividend growth rate of 14.36%. Now let's calculate John's potential earnings from a $10,000 initial investment based on these figures, starting with SCHD. In the first year, John's investment in SCHD is projected to reach $11,124. After 10 years, the same investment is projected to triple to $30,299. The compounding effect of SCHD becomes even more evident over time. After 20 years, John's money will reach $103,062. After 30 years, John's initial investment has the potential to grow to a valuation of $408,478, and he'll receive $27,553 in dividends every year. In total, this ETF has the potential to add $398,478 to his initial investment, which includes $218,183 from the growth of SCHD, while $180,295 came from the dividends. That's an extremely good return on a $10,000 investment, but can VGT do even better? Let's find out. If John invests $10,000 in VGT, after 1 year, it's projected to reach $11,995. After 10 years, the same investment is projected to six-fold to $60,984. After 20 years, John's money will reach $365,230. Give it 10 more years, and in 30 years, John's initial investment has the potential to grow to a valuation of $2,163,514, and he'll receive $2,861 in dividends every year. In total, this ETF has the potential to add $2,153,514 to his initial investment, which includes $2,130,189 from the growth of VGT, while $23,325 came from the dividends. Big difference, right? Look, choosing between VGT and SCHD depends on your goals and risk tolerance. From the numbers, we see that VGT is better for investors seeking high growth and can handle market fluctuations, while SCHD is ideal for those looking for steady income and stability. The best choice depends on your personal financial goals and risk tolerance. But as you know, for this video, we have to give the title to one of the two, and based on the numbers, that title clearly goes to VGT. Now, if you don't have the $10,000 up front and still want to reach the same $2 million portfolio as in the case of VGT, here's the second option for you, and that is using monthly contributions. To achieve the same $2 million value, you need to invest roughly $1,600 in VGT annually, equivalent to around $130 per month. This method keeps expenses manageable while working towards your $2 million retirement fund. Similarly, you can contribute around $130 per month to SCHD, and it can also help you reach your target dividend return. In fact, with SCHD, with $130 per month, you can aim for close to $40,000 in annual dividends. This showcases the snowball effect of a dividend-focused ETF, which, with monthly contributions over time, has the potential to yield even larger outcomes. Now, if you're interested in earning over $5,000 per month from a $25 per week investment, click the video on the screen.